Let's get more on today's market reaction to these dramatic political events. Joe Biden withdrawing from the presidential election campaign and endorsing his VP, Kamala Harris. U.S. markets, stocks anyway, higher, and bonds also moved up. We're joined by Young Yu Ma, CIO, Chief Investment Officer at BMO Wealth Management US. Thanks very much for coming on the show.
Thanks, Andrew. Great to be here.
I know it's hard to kind of piece it out, but what would you say was the reaction in the markets to word that Joe Biden is stepping down?
Well, it's a little bit hard to piece it out, but I do believe there was some concern in the markets, at least for some elements of former President Trump's policies, particularly surrounding tariffs. And probably the market would take the most comfort in gridlock or the status quo, because that's what it knows. So to the extent that Vice President Harris has a better odds of winning the presidential election than current President Biden does, I think the market on the margin takes that as positive, but it's still an uphill battle for Vice President Harris to actually win this presidential election. So there's a lot of time that remains and a lot of uncertainty, but the markets probably prefer somewhat along the lines of the status quo or some element of gridlock that they would take comfort in not having big changes.
If Mr. Trump or if Ms. Harris, as the candidate presumptive for the Democrats, if the Republicans win the White House or the Democrats, does it make a big difference as far as the markets are concerned?
Well, from a macro standpoint, we think it probably does not make a large difference, but we do think there are different sectors and different areas that are going to either disproportionately benefit or disproportionately be challenged by either a Democratic or Republican administration, or particularly if there's a Republican sweep that takes place and there's more propensity for policy changes on a broader scale to take place. So we do think at the sector level, there's some important considerations. For example, the energy sector is one that we would expect to do better under a Republican administration, including natural gas, which probably could do well under either administration. But also financial sector in terms of deregulation. But under a Republican administration, and particularly a Republican sweep, we might see spending cuts to social programs. And that could challenge sectors such as consumer staples and consumer discretionary. So there are a mix of factors that we think play out much more at the sector level than the broad macro level here.
One of the themes that you're sticking with is infrastructure stocks in the U.S. What kind of companies, what kind of industries are you talking about there?
Yeah, we do think infrastructure does well regardless of the environment. There's a lot of spending that is coming from fiscal stimulus bills, the Infrastructure and Jobs Act, the CHIPS Act, of course, the Inflation Reduction Act. It's pretty broad-based. You're talking about spending on factories, semiconductor factories. You're talking about nuts and bolts, roads and bridges spending, warehouse data center spending. You're getting a lot of growth in this area. Of course, recent spending on data centers is a very hot topic as well. And the energy needs surrounding that and the build out of the electricity grid. So there's a lot of snowballing effects that are taking place with this spending. And we think the majority of that, the overwhelming majority, is going to remain in place regardless of who's in power in the next after the next election cycle. So we feel pretty positive that that's going to be a continued strength there and that it benefits a lot of companies, mostly in the industrial sector, but really focus on that infrastructure element of industrials.
Would you be a buyer of electric utilities on the argument that their demand for power is likely to go up with all these data centers?
We do think the demand for power is going to go up. It's not just that. We also think interest rates are going to come down, which should also tend to benefit electric utilities. It's a little bit of a mixed picture, though, because if there is a Republican administration, some of the renewable energy might get curtailed a bit. But if you look at the broad trajectory of what's going to happen, the electricity demands over the next few years, we expect really to start ramping up and accelerating, probably surpassing what the grid is able to easily handle. And there's going to be a lot of spending, a lot of revenue generated from that. So we do think utilities are well placed here, but we think other areas will benefit as well because that electricity has to be generated. We think natural gas is probably going to be a beneficiary of that trajectory as well, of that trend as well. And so that's something else that we think, regardless probably of who's in power, is going to be in a favorable place.
That's interesting. What about your energy playbook? Would you recommend people go overweight oil and gas stocks generally?
It's a fair hedge in a portfolio, because part of the portfolio is going to be concerned about international trade. If there is a Republican, if former President Trump wins the election, particularly if there's a Republican sweep, there are going to be concerns for a while regarding trade policy, potential tariff wars, a shock to international trade. And one thing that would help to insulate or provide a buffer in a portfolio probably would be a bit more of an energy component, natural gas or pipeline component in there. We do think that would play favorably in an overall, again, as part of a diversified portfolio, but still something would provide some offset to other areas which might be more challenged.
We got a bunch of big U.S. banks reporting last week. Would you recommend exposure to the big U.S. financials right now?
We think they're in a good place here. And certainly if President Trump were to win the election, we would expect a broad-based deregulation for the financial industry, which tends to help over time and play out as a tailwind to the financial sector. The big banks have done reasonably well over the past year. We do think valuation's probably at a fair level. We don't think they're trading cheaply here, but in terms of being stable, the big banks are quite stable. So it's an area we feel comfortable with, although it's not necessarily an area that we're looking to overweight here.
And just finally, consumer, how would you recommend investors play the almighty U.S. consumer? Staples or discretionary?
Well, both of those areas face their own set of potential challenges.
Yes.
Consumer discretionary, if we take that, you really want to piece apart Amazon versus the rest of consumer discretionary. Those are two, I think, very distinct considerations. And if you look at consumer staples, and consumer discretionary together, which companies are going to be more of a beneficiary to a trade down play versus which companies could be more harmed from trade down plays? I think that's a real consideration, because there's a meaningfully large segment of consumers in the U.S. that have been challenged. Their budgets are strained. They've been challenged by rising inflation and are really looking for ways to save money. So they're looking for deals. They're looking for potential trade down plays. So I think you have to be pretty selective in these areas, but overall, they're probably not our two favorite sectors, just because of the strains that some segments of the consumer space are feeling.